on a calendar year basis, this is what you're going to probably encounter about 80% of the time, just because of the way the code and regs work as far as recognition of gains. So your gain is reportable at 12/31/2018. Again, not always the case, but probably about 80% of the time. And then then you start your 180 days. As you heard earlier, be very careful, triple check, don't wait for clients to do it at the last second to form and fund. It's really 179 days because you count the date of sale, and it's not 6 months. So you just, count the days on the calendar. So what happens here is, and this is another critical thing, we get this question all the time, say, oh, I formed my entity, I put the money in, but I know that I can push out the testing date by waiting on the when I self-certify. So I want to self-certify later in the 6-month period. Well, if you self-certify that, which won't happen until you file your return in 2020, what happens is you're going to end up with a non-qualified quaff because you funded it before it was a quaff. So you have to really watch that. Don't let your clients, or if you're a client, don't fill out the forms yourself. You really need a CPA or an attorney to help you with that. So again, in the example, June 28th is the drop dead date for a December 31st gain recognition. And then as far as the testing date goes, you count out the last day of the 6th month following the your formation date of the quaff. And so this slide assumes that you form the entity in the same year or the same month that you fund and certify. But there's actually, I've seen conflicting examples. Nova Gradic, who I trust a lot, their dates parallel what I have here. I saw a very good law firm that I have a lot of respect for the other day actually had it out another 30 days. The language is on the last day of the first 6-month period of the taxable year of the fund. So this is my interpretation and Nova Gradic's, but I think we need a little more guidance on exactly the drop dead date. So the third column there is the first testing date, 11/30, and then right after that, and there's no question on this, is the second testing date is the year end of the quaff. I also give an example down below of a fiscal year situation, and you can read that yourself, but that just kind of staggers it a little differently. But again, the first year you're going to probably have some very quick back-to-back testing. And the final thing I'll leave you with as we start to get into the details on this is, don't think of it as a 6-month testing period. You're going to really have to monitor this month to month, because you don't want to get into a situation where you're checking on the critical testing date and realize, oh man, I failed the test. You may have been able to do a couple of things in between to manage those results.
Okay, and now kind of into the meat of it, the percentages.
Yeah.
Darcy?
So we all know, sitting up here as people who work with real live clients, that everybody waits until the last minute to do everything. We think that qualified opportunity zones are not a place where you want to do that with all of these dates, and we talked, I think, in the earlier session about some of the dates being specifically set at 6 months and some are 180 days, and those two are not the same thing. And so hitting these thresholds and making sure that you're planning ahead is really important. So we'll talk, the first couple bullet points here, we've already talked about the fund level testing. So let's move on to fourth bullet point down. The fund needs to hold 90% of its assets in qualified opportunity zone property. Qualified opportunity zone property is then further defined as a qualified opportunity zone business property or an interest in a business.
Can you just get a little closer to the mic?
Closer? Sorry, okay. So we can invest in property directly, or we can invest in a partnership interest or in corporate stock. That also qualifies then as an opportunity zone investment. The fund has 6 months to invest the capital received from the investors, as we've discussed. And then we're going to measure the 90% by the average of the qualified property versus all property that are held on that testing date. So the example that Blake just walked through of the testing date is when we're looking at this 90% test. And we're going to do that based upon the value on a GAAP basis. Basically, if you have applicable financial statements, which are generally accepted accounting principles, you're going to use those numbers to do the calculation. If you don't keep your financial statements that way, which I know a lot of entities do not, particularly in the real estate space, then you're going to use your cost basis of the property. You can test, if your testing period, unlike the example that we just showed you, happens if your fund starts after the 6th month, then you only have one testing period in the first tax year, which would be at the 12/31 date, assuming that your calendar year end. The fund can apply the 90% test without taking into account any cash, investor cash that has come into the fund in the 6 months prior. So this is, if you've got rolling contributions from investors, you've got that 6-month window to get investor money into the property, no matter when that's coming in. So as a practical matter, what I'm seeing is that people are trying to limit the amount of different times they have investors coming into their fund. But as a practical matter, it's sometimes hard to get everybody lined up at exactly the same time to make it happen. And so we've got this kind of rolling 6 months that we're looking at. And in that case, you've got some room on a second tranche or a third tranche of investment to get that cash deployed. A fund that fails the 90% test is going to pay a penalty for every month that it fails to meet that 90% asset requirement. And that's going to be a penalty that is distinguished from what we talk about when we get to Valerie's section here about qualified opportunities on businesses where there's a cliff test as opposed to a test where we're only looking at the percentage that is disqualified. The fund, as we've discussed, can make an election to choose which month it's going to start, but that's one of those places that gets tricky, as we just described. But it does allow you to create an entity and to get things rolling in terms of organizing, if you choose to do that. What I have been seeing as a practical matter, again, and we'll let the attorneys talk about this, is that people effectively are getting all of their documents kind of ready and on the shelf, lining up their deal, and then kind of filing everything and making it active. See you nodding. Yeah, okay. So we talked about the asset values already. And then an important thing that we now have is that the proceeds received by a fund that sells an underlying investment can be reinvested by the fund, and you have a 12-month window to do that. So assuming that those proceeds are essentially stay within the fund, are not distributed to investors, and are redeployed within 12 months into another opportunity zone business or property, then that cash for the time period that you're holding it is a qualified asset for purposes of your 90% testing.
Can I ask a question on that, actually?
Yeah.
So this is something I was trying to figure out in the regs itself. If the sale is made, do the investors in the fund actually realize the gain at that point, or are we able to defer that gain at that point in time before it's reinvested?
My understanding right now is that Treasury has said that they don't have the authority to say that is not taxable income that is passed through, assuming that we're in a pass-through form. We agree? Yep. Yeah. So that's still an issue.
I think they want to get to that.
Yes.
They want to get to that result, but they just don't feel they have authority. I mean, I'm hoping we'll see a technical corrections bill at some point to kind of fine-tune some of these open issues.
Yeah, and then last point here, the sale within the fund does not, however, trigger the deferred gain that the investor put in the first place, and that's the key point here. So while there may be pass-through tax consequence happening, it does not taint the original deferral and the timeline for getting to the 5, 7, and 10-year windows.
You good? All right, thank you. Valerie?
Sure. So my slides are much shorter, so I apologize if you'd like to look at the words, but you just have to listen to me talk. So as was mentioned, this 90% test, that's done at the fund level. And the fund, again, can invest in, it might be a partnership interest, it might be stock in a corporation, or directly into the property. But what's interesting is that if what you do is what is called the indirect method of investing, which is into a partnership or a corporation, there is then a different level of testing that gets applied. And I think somewhere later in the slides, we kind of have an example that goes through how layering all of these percentages could end up with a really interesting scenario. But so again, at the 70% level, it's for the qualified opportunity zone business. And so that's when you kind of have an operating trader business down in the subsidiary, and they have to have substantially all of their tangible assets invested in the right kind of good assets, as they were mentioned on the prior panel. So one of the first differentiators there, instead of just the percentage, is that it's not based on all of the assets at the fund level. You're looking at your entire balance sheet, and you're saying, are 90% of my assets either the qualified property or the stock or corporate interests? You're just looking at your tangible assets. There are a couple of other caveats of what can and can't be on your balance sheet, which I'll get into. But the other important thing, which is my last bullet point here, is that 90% test, we end up in this world of potentially having a penalty assessed on missing it. At the business level, if you miss your 70% threshold, now all of a sudden that entire partnership or corporate interest is a bad asset at the fund level for the 90%. So where, being close or teetering on the edge at the fund level, not a huge deal. No one likes to pay penalties, but it's not going to ruin everything. As of right now, meeting the test at the business level is pretty crucial, because I think essentially could make your entire fund subject to penalty at that point. So when we talk about,
Sorry.
That's why I said I was bad. I just had one slide that kind of went for everything. So the other things that happen that are interesting in this substantially all, I talked about the fact that it's tangible, substantially all being 70%. That was defined in the first tranche of regulations. What the second tranche of regulations did for us is help carve out for us what the owned or leased portion means. And so that business might directly own property that's in the zone, which I don't think we talked about what qualified opportunity zone business property is, did we? Okay, so that basically, it's got to be property that was purchased after December 31st, 2017, and it either needs to be new construction in the zone, or new to the zone overall, or substantially improved. So that's kind of the property that we're talking about when we're talking about what are the good assets. So the other kind of handful of things that need to happen, though, at this business level, some of these came again in the first round of guidance, some of them in the second. And I don't have them all on the slide, so I apologize. But the first is there's this 50% gross income test that applies at the indirect investment level that I'm talking about that doesn't apply at the fund level. The second tranche of guidelines gave us some thresholds on what that means, which were far less scary than what some people had feared after the first round came out. And they're largely based on the percentage of either hours of the employees or the pay of the employees, or a combination of tangible property and where the management is doing their operations. It's also left open, kind of the facts and circumstances fallback that's in a lot of the different provisions. There's also a restriction on intangible assets. At least 40% of your intangible property needs to be used in that active trader business in the zone. Less than 5% of your non-qualified financial property, less than 5% of your assets can be non-qualified financial property. And so one of the things that we were given in the regs as well is that at the business level, they've got this working capital safe harbor. So to keep you from not being allowed to have cash and things like that at the business level, you're allowed to have this 31-month period. As long as you have a written plan for how you're going to expend those funds and you actually stay relatively close to meeting that plan, you can have cash that's in excess of that 5% and still have it qualified for purposes of this test. The last thing is, in this structure, you can't invest in what's called a sin business, which there's kind of a silly list of what it is. Some things which we would think are sin businesses, especially in this town, are not listed. But others are. And then things like golf courses are in the sin business, even though, like I said, some adult establishments are not listed there. So I think I'm good then to move forward. I think I've got one comment here. No, never mind, it's on the penalty slide, sorry.
Okay.
Move forward. So we've talked a couple of times now about what happens if the fund fails that 90% test, and that's something that's also calculated on the form 8996. There's parts 2, 3, and 4 of the form are the ones that focus on that. And it basically has you look at those 2 testing periods that were already discussed. What are your percentage of qualified assets, good assets, to the total assets in the fund? You could fail it on one date and pass it on the next. That's okay, as long as the average of the 2 is greater than 90%. If you fail it, again, not the end of the world. It's just that there's a math, I guess, equation you can go through to figure out what your underage is, and you apply the IRS underpayment penalty, which changes. I think when the program first rolled out, we were at 4%, that went up to 5%, and as of 2019, that penalty rate is at 6% now. So that's something you kind of need, like, as you mentioned, you should be paying attention to these numbers as you're going on throughout the year, because once you get to those testing dates, you're stuck with what the numbers are, so you don't want any surprises. But that's something you've got to take a look at. And then again, the penalty itself, if it's just 1 month that you're off, you're basically paying that penalty just based on 1 month. There is in the code a carve out for what would be considered a reasonable cause exception to paying the penalty, but zero guidance as to what reasonable cause is. And so I guess you could know that, especially if you feel good about why you might have missed it, you could feel good about the fact that there might be a way out of it. But I think as of right now, the instructions refer to the fact that if you end up having to fill out this section of the form, it's part 4 where you calculate the penalty, the IRS will send you a notice, with kind of an assessment in there, so I don't know if they're going to wait until then. In there is where they're going to explain what reasonable cause provisions would look like.
And then just, I think it probably is worth repeating again that this is the, there's a penalty regime for the 90%, but not for the 70%.
Right, yep, that 70% is, like I said, a cliff test. You need